Hey there, you're listening to the Investing Iguana, the podcast that gives you stock updates, news, and investing tips in just 10 minutes. I'm AD, your friendly guide to the world of investing. In this episode, we're going to dive into one of the hottest topics in the stock market, Alibaba. Is it a buy or a sell? Let's find out. Alibaba is the largest e-commerce and cloud computing company in China and one of the biggest tech giants in the world. It operates popular platforms like Taobao, Tmall, Lazada, and AliExpress, as well as Alibaba Cloud, which is the leader in cloud infrastructure services in China and the fourth largest in the world by revenue. But despite its impressive business performance and growth potential, Alibaba has been facing a lot of challenges lately. The stock has been hammered by regulatory crackdowns, geopolitical tensions, antitrust investigations, and slowing economic growth in China. As of this writing, Alibaba shares are down a jaw-dropping 75% from their peak, which was set in October 2020. So the question is Alibaba a bargain or a trap? Should you buy the dip or stay away from this troubled stock? Well, in this video, I'm going to give you 3 reasons why I think Alibaba is worth buying right now, and why I believe it will bounce back stronger than ever. But before we get into that, please make sure to hit the like button and subscribe to our channel for more investing tips and insights. And don't forget to turn on the notification bell so you never miss an update from us. Alright, let's get started. Reason number 1, China's economic reopening. The first reason why I think Alibaba is a buy right now is because of China's economic reopening. As you may know, China was the first country to be hit by the COVID-19 pandemic and also the first to recover from it. However, the recovery has not been smooth or consistent. China has had to deal with several outbreaks and lockdowns over the past year, which have affected consumer confidence and spending power. But now that China has ramped up its vaccination efforts and implemented strict measures to contain the virus, things are looking more optimistic. According to CEO Daniel Zhang on the Q4 2023 earnings call, in the past few months, we have noticed a gradual recovery in China consumption, but consumer confidence and spending power still need further momentum. This means that there is still a lot of room for improvement and growth for Alibaba's core e-commerce business, which accounts for 74% of its overall revenue. Alibaba's Taobao and Tmall platforms are the dominant players in China's online retail market, with a combined gross merchandise volume of over $1 trillion in fiscal 2023. As China's economy reopens and consumers resume their normal shopping habits, Alibaba stands to benefit from increased traffic, transactions, and advertising revenue. Reason number 2, unlocking shareholder value. The second reason why I think Alibaba is a buy right now is because of its plan to unlock shareholder value through a massive corporate reorganization. Alibaba recently announced that it will split into 6 separate business units: China Commerce Retail, China Commerce Wholesale, International Commerce, Cloud Intelligence, Innovation Initiatives, and Digital Media and Entertainment. The goal of this restructuring is to allow each business unit to operate more independently and efficiently, with more autonomy and accountability. This will enable them to respond faster to market changes, innovate more effectively, and raise capital on their own if needed. It will also make it easier for investors to value each segment separately and appreciate their growth potential. One of the most exciting aspects of this reorganization is the spin-off of Alibaba Cloud, which will become a standalone entity with its own listing on a stock exchange. Alibaba Cloud is a huge growth driver for Alibaba, as it provides cloud computing services to millions of customers across various industries and regions. In fiscal 2023, Alibaba Cloud generated $9.6 billion in revenue, up 37% year-over-year. By spinning off Alibaba Cloud, Alibaba will be able to unlock its true value and reward its shareholders with a stake in the new company. Alibaba Cloud is estimated to be worth between $100 billion and $200 billion by some analysts, which means that it could add significantly to Alibaba's current market cap of $218 billion. Plus, Alibaba Cloud will have more flexibility and resources to compete with rivals like Amazon Web Services, AWS, Microsoft Azure, MSFT, and Google Cloud, GOOG. Reason number 3, lots of free cash flow. The third reason why I think Alibaba is a buy right now is because of its strong free cash flow generation and financial position. Free cash flow is the amount of cash that a company has left over after paying for its operating expenses and capital expenditures. It's a measure of how much cash a company can use to reinvest in its business, pay dividends, buy back shares, or reduce debt. Alibaba is a cash machine, generating $25 billion of free cash flow in fiscal 2023, up 74% year over year. This is impressive considering the challenging environment that Alibaba faced last year. It also shows that Alibaba has a very profitable and scalable business model with high margins and low capital intensity. Alibaba also has a very strong balance sheet with $76 billion of cash and short-term investments and only $23 billion of debt as of March 31, 2023. This gives Alibaba a lot of financial flexibility and resilience to weather any storms or crises that may arise. One of the ways that Alibaba has been using its free cash flow is to buy back its own shares, which is a sign of confidence and value creation. In fiscal 2023, Alibaba spent $10.9 billion on stock buybacks, equal to over 5% of its current market cap. This benefits existing shareholders by reducing the number of shares outstanding and increasing the earnings per share. So there you have it. 3 reasons why I think Alibaba is a buy right now: China's economic reopening, unlocking shareholder value, and lots of free cash flow. Of course, there are still some risks and uncertainties involved with investing in Alibaba, such as regulatory pressures, geopolitical tensions, and competitive threats. But I believe that these are already priced in by the market and that Alibaba's fundamentals and growth prospects are too attractive to ignore. Moreover, Alibaba is operating in a highly competitive and dynamic environment where it has to contend with rivals like Tencent, Tsiyi, JD.com, JD, Pinduoduo, PDD, and ByteDance. These companies are constantly innovating and expanding their offerings and could erode Alibaba's market share and margins. Therefore, you should be aware of the risks and challenges that Alibaba faces and weigh them against the opportunities and rewards that it offers. I think Alibaba is one of the best bargains in the market right now, and I'm confident that it will reward patient and long-term investors. But you should make your own informed decision based on your risk appetite and investment goals. I hope you found this podcast helpful and interesting. I'd love to hear your thoughts and opinions on Alibaba and other stocks that you're following. You can leave me a voice message on our channel or send me an email at investingiguana@gmail.com. And if you like this podcast, please give it a clap and share it with your friends. And don't forget to follow our channel for more investing tips and insights in 1 minute or 10 minutes format. You can also let me know which format you prefer and what topics you want me to cover next. Thank you for listening to the Investing Iguana, and I'll catch you next time. Happy investing!